I'm Hannah Moore, CFP, a practicing financial planner and educator. I'm on a mission to change the way people think and talk about money. Let's get started. The stock market is in the news again, and not for the best of reasons. This week, it was announced that we are officially in a bear market. Now, what does that mean? A bear market means that from the market highs to where we are today, it is down 20%. That's usually what defines a bear market, which is pretty significant if you have investments, right? We want to see our investments go up. We don't want to see them being going to go down, but that's very much part of the market cycle. So what is happening? So let's talk about what is happening. What is causing this? Now, one of the things that I think is really important to know is when we start talking about the stock market, there are so many causes. And it is very hard. We could probably list out 20 or 30 different reasons. Now, there are several that are the kind of the pressing ones that really make this a unique situation. That's not what it's not what we faced in, 2020 with the COVID pandemic. It's not what we faced in 2008 with the housing crisis. There's different sets of facts that are happening right now in the market that are causing it to be a bear market. So the first one is inflation. Now, if you live in this country, you guys know what I'm talking about. A trip to the grocery store, my gosh, it is so different now, right? Like it is just more expensive. Every time I go to the grocery store, I'm just like, oh my goodness. Like, I think every time I come home now and tell my husband, like, I can't believe it. Everything is going up. And so we're seeing this across the board, right? We're seeing this obviously in the grocery prices. We're seeing this, certainly in housing, and there's a lot that goes into the housing market, but inflation is a big piece of that. We're seeing this, in the job market of what people can command for a salary. We're seeing this all over the place. And inflation can be a really daunting thing for an economy, right? Earlier this year, there was a lot of talk about, if you have money in cash, you're actually losing money, right? So inflation was about 7% in 2021, and we're on track to be about 8.5% in 2022. So that's significant, right? So that means that if we have $1,000, what $1,000 can buy us today, or what $1,000 could have bought us, at the beginning of 2022, by the end of the year, that $1,000 is going to be like $866 or whatever that number is, $850. It's going to buy you, like, you're going to actually $850 at the beginning of the year, when you have to have $1,000 at the end of the year. And so that's not good for the average person in an economy. And it can be a very difficult thing to manage. And so in our country, we have the Federal Reserve, and their focus is on helping make sure that there's a healthy economy. And so one of the biggest tools that they have to fight inflation is interest rates. And so that's what they've done. They have been hiking up interest rates, and they're likely to go up again in a way that we haven't seen them go up in many, many years. Now, I just said that we're at 7% inflation for last year, and 8.5% we're on track for this year. To give you guys context, for the last 10 years, it's been from under 1% to maybe a little over 2%, has been what it's been for many, many years. I'll tell you, as a financial planner, when I'm doing my projections, I project inflation to be 3%, between 3 and 3.5% over time. Now, I'm still maintaining that assumption in my planning software because I think that these are going to level out, right? Like, we're looking for averages on this, but it's a very real concern for the health of our economy is inflation. And so, like I said, the Federal Reserve has started to raise interest rates. And so there are some immediate impacts that happen that we all feel, right? So the first one is housing prices, the mortgage, the cost of buying a home, right? Your home can still be worth the same amount, but what is the interest on that loan, right? So every 1% increase in interest rates usually causes a 10% decline in how much money you can borrow for home purchases, home improvement purchases, cars, what's going to be on your credit card, in all, student loans, in all of these different places. So rising interest rates makes it harder to get money. And for the average person, they're seeing it, in those areas. Now, for businesses, they're seeing it as well. So one of the things when the economy is not doing well, and this is going to be how it was different than in past years, with like 2020, the most recent example, is that interest rates is one of their tools to say, okay, we're going to drop interest rates so it's easier for you to spend your money. And that's going to help the economy. The more that we spend money, the more it's going to help the economy. And so now what they're doing is they're actually working against, they're not trying to spark our economy. They're not trying to get people to spend more. They're not trying to get businesses to grow. What they're trying to do is actually curb inflation. And so this is a new phenomenon. It's not new. We've seen it, decades ago, but it's something new for our environment today. And so we're seeing them increase those interest rates. And so as they're doing this, we're seeing the stock market's responding, right? So when we look at stock, you own a portion of a company, right? That's what happens with these companies. And when they try to figure out that ownership of the company, they say, how much is this company actually worth? Well, they do that based on lots of different projections. This is like an entire degree, entire degree in college and advanced, all the things that kind of figure all this out. But they figure out, how much they expect this company to earn. And now, when the interest rates are low, companies can be borrowing money and can be growing at a much faster rate. When interest rates go up, it becomes a lot harder for companies to borrow money because they're having to pay more in interest. And so it slows down the growth of these companies. So a lot of what's happening right now is all of these companies, their valuations are going down, right? Because they don't expect them to grow as fast because it's harder to grow when you're having to pay a higher interest rate on your loans. It's harder for them to grow. The other thing that's happening is that people want cash. They want the safety. And so there's a supply and demand aspect of what's happening right now too, is that people are wanting to say, you know what? It's more important for me to have cash right now than it is for me to be invested. And so they're pulling money out of the stock market. And so that's part of what's happening as well. The other thing that makes this market unique is that we have the rising interest rates, like I've already talked about. So usually when we start investing, we look at the stock and bond allocation. So stock is you're an owner of a company, right? Like it's pretty cool that we can do that, right? That I can go be owner of like Walmart and Target and Amazon and Meta or Facebook. I can go be an owner of this company. The other piece is I can actually be the bank for companies, right? Like, how a bank gives you a mortgage? You can go lend money to companies through bonds. And so what happens is when interest rates go up, let's say we've already loaned this money to a company, to a government. We bought it in, U.S. Treasuries. There's a lot of ways to do this. I'm really simplifying it down, but there's lots of different ways that we can loan this money. But when interest rates go up, nobody wants to buy our bonds that we already have because they can go get a new bond that's going to be paying them more. Right? So with a bond, you give a certain amount of money, and every month or every quarter or twice a year or once a year, whatever the agreement is, the company or whoever you loan the money pays you interest. It's exactly what happens in your mortgage, where you every month are paying the bank this interest, right? You pay principal and interest. So you're actually getting that interest payment. But what happens in the bonds is that when interest rates go up, bond prices go down, because nobody wants to buy the bonds that you have right now that we've already bought, because they could go get new bonds at a higher interest rate. And so because of that, what's happening in the past, we have stocks and bonds. When stocks go down, bonds tend to be safe with quotes around it. They tend to be, they don't respond in the same way. But what's interesting is with interest rates going up, bond prices are going down and the stock values are going down. And so what's unique about what's happening in the market right now is we're seeing every single area go down. So that's what's happening right now in the market. And that's what makes it a little bit more unique. This certainly has implications for families who are buying homes right now, selling homes. There's a lot of complexity in that space right now. We're certainly helping clients navigate that process right now at our practice, but that's kind of what's happening right now in the stock market. Now, a couple things I want to remind you of. At the end of the day, we're investing in companies to make money, right? For these companies to make money. They have CEOs of these companies where their mission is to make money, right? And, yes, this market is going down, but has it actually changed what's happening? Like, is Walmart actually worth less money today? And perhaps, the answer is yes, right? Like, it is worth less today than it was, 2 weeks ago. But that doesn't mean that it's going to stay down. And so one of the things, it is one of the scariest parts of investing is that it's so important to be riding the ups and the downs. And so this is really where, when the market is down, it's where people can make the best and worst financial decisions. So when the market is down, we have to be careful not to be selling out of our investments. We have to be careful that we understand, what is this money there for? Is this money there for a long-term financial goal? Then don't sell out of the market. Don't be, making sure that you guys have a good strategy in place. But these are the downticks. I have a lot of confidence that these companies are going to figure out how to make money again. That is what they are directed to do by their boards. They're going to figure out how to navigate this environment. And so it's really just becomes about, as long as you're in here for the long haul, to continue with your investment strategy. Talk to your financial planner, talk to your financial advisor about what this can look like. Because yes, this is a dip, but it does not mean that you have to that you have to sell out of your investments. We want to be buying low and selling high. And so that's what we really want to be doing. So giving you guys a little context of what's happening in the market now. And I would just really, really encourage you. This is not a call to action to go sell. This is not saying that this is going to be forever. This is not saying that it's going to get so much worse or that it's going to get better, because the truth is we don't know. We don't know what's going to happen with the stock market. What I do know is that when we look over time, when we look over not a month, not over 6 months, not even over a year, but when we start looking at 5, 10 years, 20 years, we know the direction of the stock market, and that's going to be up. And that's what we look at. We've seen these market declines in the past, and I will tell you that it's a cycle. It goes up and it goes down. And the best thing that you can do is make sure that you have a good strategy and continue to execute that strategy. It is something that you most likely, just about everybody, won't regret. Won't regret that. But we are in a bear market now. I am not panicking. Most of my clients aren't panicking. I say most of them. Some of them have, some tricky situations they're working with right now. But most, if not all, my clients aren't panicking because we have a plan in place and we're executing it. So good luck as you guys continue to listen to the news. Know that yes, it impacts your personal finances, but the most important thing you can do is focus on what it is that you can control and navigating that. Because the more you do that, the more successful you're going to be. Good luck, y'all. Thanks for listening to this episode of Everyday Money with Hannah Moore. If you like what you heard, subscribe and check out livewealthynow.com. We have a lot more resources to help you live wealthy now.